Hi again, everyone. We're going to get started with our second panel. Please help us welcoming our panelists. Steve Wardle, Asad Mahmood, Annibale, and Sebastian von Stauffenberg. I'm sorry if I mispronounce it. Sure. Please give him a round of applause, and I'll hand it over to Steve. Unfortunately, we had a last-minute cancellation from Camila Nestor. She won't be able to join us as moderator, so Steve is going to play the dual personality of the moderator and panelist. So again, thank you very much, and welcome.
Thank you. Thank you. Well, it's quite a pleasure to be here. We have a very esteemed and interesting group of panelists here. I'll first introduce myself and then ask each of the panelists to introduce themselves. My name is Steve Wardle. I work at the Grameen Foundation, and I'm the manager of investments. We have several different investment funds that we use to invest in microfinance, and then also kind of some smaller funds to invest more broadly in kind of financial inclusion and livelihoods. And we offer mostly guarantees, but also some direct debt and equity investments. So Asad, Mahmood, go ahead and introduce yourself and tell us a little bit kind of how you fit into the microfinance space, and then Bob and Sebastian as well.
Yeah, I work for Deutsche Bank, and Deutsche Bank was the first bank, global bank, to actually create a microfinance fund. And we have been doing it for 14 years, and I've been part of it from the beginning, and I've seen the industry grow, and people like Bob and Christina Leuenhofen and Morgan Stanley and other banks come, so it's a great opportunity, and look forward to this discussion.
Great. I'm Bob Annibale, and I head up Citi Microfinance Community Development at Citi. And we've been involved in microfinance at Citi through the foundation for a very long time, almost 30 years of support with Axions and many networks here. And about 6 years ago, I guess it is now, my goodness, I was talking to Asad at the time, really established a group called Citi Microfinance, which for us was to run in parallel to our philanthropic work, but really to work with microfinance institutions and networks and investors as clients and partners for certain products, and particularly leveraging, I think, for them, our presence and our footprint domestically in so many markets, locally in so many markets. So we do, and we work with, many institutions in some 40 countries locally, particularly, on financing and developing products and accessing markets.
Good afternoon. My name is Sebastian von Stauffenberg, and I'm a bit of the odd man out here. Since I'm not an investor, I represent a rating agency. We were founded, I guess, in 1996, and are the very first specialized rating agency in this sector, in microfinance. I think I would have had more to say in the last panel, because most of our work is dedicated to evaluating microfinance institutions. And since everybody on that panel seemed to be a client of ours that we've recently rated, it would have been very interesting for me to poke holes in what they were saying, but I kept my mouth shut. But I guess one of the reasons we have something to say with this is over the last couple of years, although in '96 we saw that there was a lack of transparency on the MFI level, since then, certainly in the last probably about 5 or 6 years, we've seen an explosion of these funds that have been created, and to a certain degree a lack of transparency on the fund level. And so you have investors that want to invest in MFIs, and they're using these vehicles as a means to get the money to the different countries and microfinance institutions, and yet they don't really have much information on them. Fortunately, most of them, or many of them, are actually quite transparent of their own, but many investors want to know from a third party, what does this really mean, not just get the nice presentation from the actual fund. And so we've started to do that to a certain degree over the last couple of years, is evaluate the funds themselves and shed some light on that. And we've worked with several of the funds to do that and to help investors make, I guess, more educated choices and really match their investment profiles with the investments that they're making. So that's a little bit of what we do, and I'm sure we can go into more depth on that once. I'd really encourage more questions, and to the moderator to sort of get the questions going as quickly as possible so that we can address them and really address what you want to hear, not so much what we have to say and what we've said probably many times before.
Good idea. Excellent suggestion. I will do just that. And so what I'm going to do is essentially play the role of moderator only, try to keep my mouth shut other than that, and hear from my esteemed panelists and also from you. I'd like to leave as much time as possible for questions. So please be thinking of questions that you'd like to ask these experts in the industry. I think so. What I think I'll do is just kick off the questions that were prepared, and I'd like to pose them to individuals on the panel. If some of the rest of you have things to add, please feel free. But first of all, Asad, why don't we talk a little bit about? Would love to hear your perspective on how you see the investment environment changing over the next 5 years. It's a pretty broad question, so you could take that a lot of different directions, but the mic is yours.
Yeah, thank you, Steve. I want to start by talking about the title of this meeting, Extending the Horizons of Microfinance. And the key question in my mind is, in what direction? Is customer care equal to customer value? Is customer value follows customer care? Or customer care and customer value are not related? So people who think customer care brings on customer value can raise their hands just to get a sense of it. Okay, and people who believe that customer care and customer value are one and the same thing, raise their hands. Nobody. The loner. Wow. And people who believe that they are not related at all. Okay, one person. Okay. I think the fundamental crisis that is at our doorsteps and in our houses is the crisis of lack of customer focus. So the question posed is, how will the investment landscape change in the next 5 years? I can tell you one thing for sure. It'll be very different than what it is today. If this industry is to achieve its goals that were always proclaimed but never accounted for. So certainly Deutsche Bank, as one of the, certainly I can claim that on the investment side, I'm one of the oldest fund managers in this, not age-wise, I'm still young. Old in terms of managing this fund for Deutsche Bank for 14 years. So I think for me, technology is a great leapfrogger that will help the investment process. But the core of it and the core of investments in microfinance ultimately will be successful if we care for the customer. I'm going to say a couple of things, and I'll shut up after that, but the important concepts that I want to relay. There's a lot of political dimensions to microfinance that are not obvious to people who are new to it, and has its root in the debate between Grameen and Nexion in terms of commercial and social focus. And I think that was a wrongly placed debate, because what it did, and still does, and Dr. Yunus has done I respect him a lot, so don't get me wrong, but I think he's done a disservice to the sector to be critical at a time where this industry was unfairly being attacked as the pendulum swung from angelic to demonic attributes that were given to microfinance, and the truth of it is much more nuanced. So for me, the core is that there is nothing like social value. It can be all distilled to one thing, and that is customer satisfaction. If customer is satisfied and that you are adding value to the customer because who they are, because at the bottom of the tranche, they're not necessarily smarter and dumber than you are and I. They're a statistical bell curve, but certainly more in need and unsophisticated. But if we can add value to them by creating assets, by providing products that are sort of more meeting their needs, then we've taken care of all this social idea. So for me, there is no commercial versus business approach. And I will remind Bob that once we started, I really was the loner because I worked in the corporate social responsibility and publicly said that Deutsche Bank's interest is driven by its corporate citizenship responsibility, but we are trying to use business methods to achieve social goals. So from an investor perspective, there was a question asked that if there should be a separation between these two things. I think at some level, yes. But in the initial side of it, all the investors for Blue Orchard and Triple Jump and Tridios and Deutsche Bank and Citibank who are interested in this sector do not come to this sector because it is diversifying their risk, because it is adding a lot of financial return. Their primary motivation at this stage of the game is still to do good and preserving their fiduciary capital. So the horizon of that I do not see changing in the next 5 years. I see that element of it increasing because of the aggressive commercialization in India that broke the back of the people who argued for commercialization based on theories, economic theories, that don't work in the most efficient markets in the world of competition bringing down pricing. You don't go from a monopoly to free competition, that you go through a phase. And I think that is the future of the next 5 years for investment. And I have other things, but I'll keep it to that.
Thank you for that. Bob, Asad has mentioned this sort of debate between what type of, maybe I'll put a little bit of words in your mouth, but what sort of capital is appropriate in the market? And, we have on the issue, and touched a little bit on what's happened in India. I know Citi has been very active in India, and I'm sure right now are very busy times for your group. I'm curious to get your perspective on how the events there have sort of helped shape the discussion and the debate about what is appropriate investment capital for the industry.
Sure. I think Asad sets it very well in tone of, especially in that these primary institutions that he's speaking about that have been involved for lots of different ways, everything from their philanthropic through to their business tools that we have, all of us, have really looked at this from the perspective of having an element of trying to cause good development and a positive financial inclusion, responsible inclusion. And then with many different bits of social impact that people are trying to achieve, and for some it's just responsible financial inclusion. But it comes from that angle of our origins as institutions. And I think the types of capital, we don't have a fund or manage a fund, and Asad's had that history to see that evolution longer. But we have it from a philanthropic perspective, and then as we see institutions, perhaps sometimes because we're so local. We see institutions in a local context primarily, not New York or London, and in the same local market, in the same currency, in the same central bank, the same newspaper. You can read the front page wherever you are, in Citibank Dhaka or Citibank Kampala or whatever. And access to capital is about accessing capital that is appropriate for that institution's objectives and goals. And I don't think that there's any contradiction there in being able to be very socially motivated as many people would characterize institutions, or a nonprofit versus a commercial in accessing capital particularly, it does, perhaps when we talk about capital as equity. When we talk about capital as equity in particular, I think that can alter an institution very significantly unless shareholders' interests are very much aligned with the mission of an institution and its strategy. Otherwise, institutions, it was 3 weeks ago, we were working with Grupo ACP in Peru, which did a bond issue. Citi was working on a bond issue with them. It's $85 million. Grupo ACP is a nonprofit. Now, and it has a presence in a number of Latin countries, but it did a public bond issue. It is a strong institution with a committed mission and an ownership that it happens to be non-for-profit, but it didn't mean it couldn't access capital. So I don't feel that there's that contradiction in there at all. And overall, though, I think the issues you asked about India, it came up earlier. The example of India is also how complex India is, that one doesn't underestimate that it's a federal system, that there are very diverse states, which are, and regulatory environment for microfinance suddenly came up above the radar, is the way I only could describe it, from being a very local NGO, largely NGO-focused activity, to one that was very significant, and particularly in one state. And I think it's caused many people to re-examine, not least of which to re-examine the regulatory framework in which institutions operate, and as they change their context and as they change either their business models or their legal entities. These went, for many of these institutions, were NGOs not long ago and become non-bank finance companies, scaling significantly, and particularly out of one center. And the realities of the complexity of local markets and franchise risk, the risk of growing very fast sometimes, the risks of going faster than perhaps supervision and regulation is there to oversee. And many of the other things Asad has intimated to in the case of India. So I think the example of India is not the example of all India. It's the example of Andhra Pradesh. You have very left-wing states in the south and in West Bengal, a communist government party, and microfinance is operating almost as it did before. Funding is harder, but not the operation of the client. And that is one state in a very big, important market, which has a great deal of coverage. But as we saw, Nicaragua went through areas, Bosnia has gone through different extents, Morocco of over-lending or defaults. It isn't characteristic, I think, necessarily, though, of the global trend. But I think we have to really appreciate, as you said earlier, the nuances of this sector.
Thanks. Quick follow-up question on that, Bob. You mentioned that there are a couple of factors that are important in order for growth to happen appropriately, and almost suggesting that maybe it is possible to grow too fast. Would you agree with the statement that it is possible for a microfinance institution to grow too fast? And if so, what are the factors that would cause that, and what are the ways to avoid that?
Well, I think this is not so different than what we've seen in many other credit markets, to be realistic, that markets can grow very rapidly, and you can be either supply-driven or even, regulatory changes or otherwise can allow for that kind of demand to come, express itself through just borrowings. We've seen it before in Morocco, we saw it in Bosnia, we saw it in other markets where there was rapid growth and there was a lack of, maybe perhaps there's two things, lack of an infrastructure in terms of, say, credit bureaus and the kind of mechanisms that could, in some ways, capture that and make it even more aware that those aren't tools that have necessarily worked on this market or in others that have overheated at times too, but they were lacking completely. And also a regulatory framework that might have addressed that in some way. I think in the case of India, that wasn't the case. There wasn't necessarily a regulatory structure in place for the non-bank finance companies for which these operated that would have, in one way or another, looked at that and addressed it. I don't know what is too fast or not. I think it's one of those things when starts to sense, at notional growth, just operational capacity, the ability to train people appropriately who are, the incentivation, many things have to be taken into play. And we keep in the financial industry keep relooking at this. Unfortunately, it isn't something unique to microfinance. But I think that the lessons of other sectors are just as relevant to microfinance.
Thank you. I think this is a really interesting topic, so I just want to pause here for a little bit longer. There is the accusation, I will call it an accusation, against venture capital firms, purely for-profit money. And specifically, if we're going to talk about India, let's call it, say, Sequoia's investment in SKS. That was really the driver behind why SKS grew too fast, if you believe that SKS grew too fast, and maybe focused too much on the mullah and not enough on the client.
It's not the mullah in the mosque either. That's a mullah.
Yeah. Good point. So I guess the question I would have is, did the growth in SKS, did it happen because of the entrance of Sequoia, or was it happening before Sequoia came? And it was really the intention of the MFI, which brought in a player like Sequoia, because there was alignment in their objectives.
Good point.
Any of the panelists have a comment on that?
I don't really have a comment on the SKS because I don't want this to be an Indian panel where we talk about the case of India, although I think it would be interesting.
Or have we seen it elsewhere? Have we seen it elsewhere?
But
Yes.
going back to your original premise, which is growth, and I'll venture an answer to this SKS just off the top of my head, and I would say no, meaning this is the straw that broke the camel's back, but it's not the only thing. Certainly there were other things, and it's much more complex, and I do believe that both Bob and Asad's points were true in the case of India. But going back to growth, and as a rater, when we look at an institution, we absolutely think that there is a correlation between risk and excessive growth. We definitely have alarm bells go off when we see growth rates in excess of 100, sometimes 200 or 300%. I mean, this is crazy. Now, it doesn't mean in all cases, but when we talk about it in a rating committee, we think of, and I always think of a suit. Does the suit fit the person? And in this case, does the organization fit the environment that they're growing in? So it's not just about growth, it's about what kind of structure do they have in place to ensure that this growth is being done in a healthy way. And so there's some outfits that have a very loose-fitting suit, and so they can grow into that, and they can grow rather rapidly. 100% is fine. Where there are others that are bursting out of their suit. I mean, I've been to offices of general directors that have a stack, literally, they hide behind this stack of files that they're personally supposed to approve. And I'm like, this is insane. You've got 500 files that you're supposed to personally approve. This is going to be a disaster. You're bursting out of your suit. So it didn't matter that the growth was only 10%. They were already way beyond what they should have been. And so I think it really is relative to the situation, and you have to really evaluate it with the context and the institution in mind.
Yeah, good point. So another question for you. You have, as part of your product offering, both a financial and a social rating. The original question is, will investors over the next 5 years be primarily interested in financial returns, social returns, or both? Specific to you, I'm curious, what has the demand been from investors for social ratings versus financial ratings, or both?
That's a good question. My short answer is both, but the long answer is I think there are two tiers of investors. We kind of throw in the term investor to cover everybody from Citi all the way down to the investor in Kiva's website with a tiny loan, and these are totally different animals, and their motivations are completely different. And so, not in the case of necessarily Citi and the Kiva investor, but there can be a whole slew of different types of investors, and we always separate it into two broad groups. One is the actual vehicle that's making the investment in the MFI, which we term an investor, but really it's more of a middleman position. And then the ultimate investor, and what are they looking for? And so I think you need to really look at the Deutsche Banks, the Blue Orchards, the Chiodos, all these names that we've thrown out. What are they looking to do versus the people that are investing in those funds or vehicles? What do they want? And going back to Asad's first comment with regards to customer service and value, really his responsibility as a fund manager is to make sure that he's satisfying and both the end borrower on the one hand, and then the investor that's investing in his fund, because they have a specific mandate. And so when you ask the question, what are they looking for? I would say, unfortunately, today, the vast majority of the funds are doing what they should be doing, which is protecting their investment. So for them, the number one thing is, the vast majority, not all, is risk. They want to know, what kind of risk am I taking? And then price it accordingly, more or less. I would say that most of it is underpriced, but that's another conversation. I would say that other investor, the one that's above, and more is looking to social issues. And they're going to force, and are in a certain degree forcing, the funds to ask themselves questions and set it up so that they can satisfy the needs of those investors. So I think you're going to see more and more of that corporate social responsibility and that desire to do something and have some kind of an impact investment.
Mm-hmm. Sure.
I think Sebastian says very interesting, and I think it correlates to what we've been saying before, because there are those who are really trying to measure social impact, and for which microfinance, as I said earlier, didn't do for a very long time. I mean, it anecdotally did, and it had demographics that seemed to display that it was reaching the population that was being, discussed. But how it changed and what impact it made on people's lives and change is something for which there's increasing amounts of data now and information. But those same questions are correlated to, I think, what Asad was also saying in terms of the client and the customer focus and the knowledge around the client. I mean, the social ratings are an evolution. If you look at the different agencies and what they're doing and what any one of us are trying to understand, but it is about the dynamics of not only who you reach, but how you've reached them and what is the impact and what happens to them. And you may be motivated by do no harm as an investor. You may be motivated by I want to make significant inclusion or change or progress in other multiple aspects of the quality of life. We saw that before with PromaHair and how they have a very different holistic view where health and education is also a part. It complements, and microfinance is not their end goal. And others, that might be their goal. So I think the transparency and the ability to question and have more data around that, something that the agencies are doing, and we're all doing it ourselves internally too, it's going to help us again as we all go back to looking much more closely at the client and who is exactly the client segment and what was the impact of their being served by that institution. And I think that this is something for which we have different investors with different needs in terms of social impact, results in the way they make investment decisions. But I think everybody who wants to understand an institution well, that is involved in this segment, will benefit from that output too.
Diversity of approach is necessary for a healthy environment. It's like biodiversity. You need to have different perspectives to broaden the pipelines to grow the social sectors. We haven't given up on the social sector. We're very positive on the social sector. But what we are trying to do at Deutsche Bank, because we are a big bank, and I sit on a big elephant, not as big as Bob's, but it's still big.
Big elephant.
It's a big elephant. And I used to work for Citi, so I can say some things about Citi. But I think Bob has done a tremendous job of really bringing the businesses into it, and I think that is probably one of the biggest challenges that Bob has executed tremendously well. But so I think to the point that I am not against any particular approach. I think that is good. We should have innovation. But what I am trying to say to you is that all those approaches ultimately have to worry about customer satisfaction and customer value. And to answer the question that I started with, and my only friend here that sort of believes what I believe, is that there is no difference between customer value and customer care. They're interconnected entities, that you cannot have them. Customer value is created through customer care, and customer care comes from a value at the board level, what Steve had talked about, that they knew who they were getting in bed with. So they are very interrelated from that perspective.
So we've heard a lot from Asad on the alignment of how it's critical that both in the governance and all the way up through the investors, there's an alignment that there's the investment should at least do no harm, and also in its best form be aligned with the needs of the client. I was wondering actually if you could take a few minutes just to plug the initiative that you've taken some leadership on. I think it's the
Which
principles.
one? I'm a leader of so
There's
many.
so many. I know. The principles for investors in inclusive finance is, I think, something that embraces this idea that we need a diversity, right? First of all, no one of us has enough money to satisfy all the needs, and also because there's a diversity of actors there, and because it's important that there's alignment between what the board wants, what the organization wants for its clients, and what the investors are looking for. We need diversity. But there are certain principles that I think are being put forth for the investors that want to be in this space of inclusive finance. Well, I know you've been active in this. Can you just talk about it for a moment?
I think I first of all want to say that, let's move away from the pessimism and the worry, because worry doesn't do anything. But I think we should be proud of that the industry has not been sitting on its laurels for the last several years, that they have reacted to what was, because people in the know knew this before you knew. That's obvious. So there are efforts on microfinance transparency that Chuck Waterfield is leading, an excellent initiative. There are efforts on creating matrices for social performance that tie into the business that Laura Foos is sort of leading, and Leah is working in that sector. Not perfect yet, but they're getting better. Then there is the effort which started out by being called the client protection principles, that centered around 5 things in terms of transparency of pricing, not to over-indebt clients, and to be ethical in your behavior, and not to have coercive collection methods. So the initiative has grown, and the latest is that the client protection principle went to, because it was sort of a name that had some implications, people's minds, so it became the SMART campaign, and the SMART campaign is now working to create a certification process for MFIs, like fair trade, where we can go and sort of, be comfortable that these institutions' constitution is ethical, that their drive for profit is not sort of circumventing the desire for social results. And it is, so those are the things that I think are, I wanted to make sure that people didn't sort of see this as negatively as the press is portraying it. And if I may take a minute to talk about the Esther Duflo paper and the randomized trial basis, if you don't mind.
Quickly, and then, because I'd like to make sure, we think we've got about 15 minutes, so I'd like to make sure that you all have questions. If you have questions, please be thinking of them. I'd like to open it up soon, but please go ahead.
Yeah, and I think, Esther Duflo is a very nice, smart lady, and, has done a very interesting paper in Spandana. She's a very innovator. She has designed some really interesting tests in dealing with poverty. But I think the problem is that when this study was done, the press didn't see anything else, but they saw MIT, Esther, who has a reputation of a superstar, and some conclusions for the paper that were not the whole conclusions. They didn't look at the problems with randomized random trials. What is it called? Randomized control trial, RCTs. So the issue was, here's the story from the inside. What happened is that when they went to the Spandana, they tested clients that were Spandana clients, and then they got people that were others. In Andhra Pradesh, like Bob had said, there's such a large penetration, not only from money and lenders, but self-help groups and other microfinance institutions. They didn't adjust for that bias. And how can you compare You also have microfinance. I have from Spandana, and say that there is no difference. And they state that in the study, that they wanted to do the study in real life. But to me, that doesn't make logical sense. The other sort of thing to remember when people tell you so definitively that this sector has no value is that randomized trial, first of all, the sampling size has to be really big. And second of all, the period of time has to be large. The Esther Duflo study was done on an 18-month period. That is just a couple of loan cycles. And it is, and she points that out herself. She reacted quite interestingly. She said that the microfinance industry, took it so badly when I didn't mean that. And I pointed out that this is one method and not there are flaws in that method, but based on that, here it is, sort of idea. So I think that's a very important issue, and I think we need to have a campaign to understand what the academics are saying more interestingly, and we have to act collectively to defend and improve the sector. So I think that is very important. So sorry for taking that much time.
Thank you. Thanks for that clarification. We had a couple of more questions. If you'll excuse me, Bob and Sebastian, I think it'd be good to just open up with the last 15 minutes instead of posing the rest. I think just in summary, we've heard some interesting points from the panelists. Well, first of all, a need to understand, get the research right and interpret it appropriately. But I think, more than that, there's a need for research. It really is important, not just to think about doing no harm and not just to talk about social performance in a very broad sense. At the core of it, if people are saying that they are investing to alleviate poverty, or they are investing to do some good, however they define that, those impacts actually need to be measured. And that's an important but not easy piece of the picture in social investment, and something that I personally don't believe will really take off unless the investors themselves push for it. I think we've heard about some of the dangers of in contextualized, growth that is inappropriate for where the market is or where the institution is. Regulations that are in place, credit bureaus that are in place, even just internal systems that are in place are important. And I think loud and clear as well, the interests of the clients need to be put first. I think that's good business practice. Right, so this isn't just unique to financial inclusion or the social aspect of microfinance. This is sort of business 101. We're dealing with the poor here, or at least the financially excluded and marginalized. So I think you could easily argue that this is even more important. Thank you for all your comments, and please, if you have some questions, I think we've got probably another 10 minutes or so. Please pose your question to either one person on the panel or to the entire panel.
First off, thank you to each and every one of you. I think you've all added a great amount of value to this panel today. So this question could really go for any one of you, since you all bring a unique global perspective to the table. Being that we've seen such a great amount of demand out there in the world, across the whole world, are there any particular regions you see going forward that are going to show the greatest growth? And are there any particular regions where you see it might start to pare down a little bit with a lot of political and social turmoil around microfinance?
Can I respond? I think, again, it'll come back to what you only mean by microfinance. If we mean serving those who have not had access to formal financial services in a wide range, almost all the talk we have of microfinance excludes both China and Brazil on the whole. They don't come up, and the NGOs don't play any material role. Both countries, very significant banking systems, that is the model that's being used. Perhaps the fastest growth in financial inclusion, if you think of it that way, as the Indian government describes it, which is really about the bankerization, not about the microcredit side, but say it's about savings accounts and transaction accounts, payment accounts. Perhaps will happen in markets that we're not at all speaking about. I mean, any one of those out is the size of much of Africa. If you think in terms of, the scale, certainly even of Brazil, where it's very rapid expansion happening both from a public, income redistribution and interesting systems that Lula has introduced before, and bringing up 20 million people from poverty, about the very large public sector banks, the Caixa Econômica, the Banco do Brasil, the private sector banks moving down quite significantly. So I think one of the challenges when we think of, microfinance and how are you reaching that segment will be, is it a bottoms-up NGOs transforming scenario that you're looking at, which is the discussions we've had largely so far, and the kind of institutions that most people look at. Well, will it be as it was and still continues to be in Turkey or Brazil or other countries, one of where the banking system moves in a different direction, and certain banks and certain types, postal banks and other things. So I think that it will grow at a different pace. Markets are different. And the biggest challenge is where this sector has been led by NGOs who are now challenged with trying to reach very large numbers. And what does that do to the mission and the model? And that's a very challenging place to be, as opposed to banks or public sector entities that are moving deeper and wider. And theirs has always been an understood mission and limitation of their capacity to what they can deliver. But I don't think it's even. I think Latin America is continuing to expand quickly and maybe unevenly in many countries. But it's probably not any longer going to be, because new institutions, as NGOs, are going to only fill the gap. But I do think you're getting the segmentation, and we're beginning to understand better. As you understand client need and client capacity, and that segmentation, when the majority of people are unbanked, if you want to use that term, well, they're not all in the same category of either need or capacity. And they probably will be served by different types of institutions, as many people are in any other society. And I think that complexity is being more visible through all these discussions that are happening now.
I'd just like to add on to that quickly, sorry, and we'll get to another question. But I think the focus for the past decades has been what's the growth? How many people are being served? And mostly, how many people are being served by the specialized microfinance institution? The NGO type that may or may not have transformed. I would like to see the discussion move beyond just how many kind of short-term working capital loans can we get out to as many people as possible that may or may not already be served by some other informal lender in their local community. But how many people can we serve with appropriate products? Things that they are appropriate to their needs. We have a particular emphasis at Grameen Foundation on the rural poor. And by and large, the kind of trader that needs a short-term kind of, has a high-velocity business and a short-term product works for them in smaller amounts, may not be appropriate, and oftentimes is not appropriate for the 70% of the world's poor that lives in rural areas and is largely engaged in agriculture. The needs there are different, and agricultural finance or finance that is tailored to people's particular needs is way behind. So, I would love to see growth in products that are tailored to specific needs of underserved clients, more so than just rolling out the same type of product to as many people as possible.
So this question's for Sebastian. How exactly do you measure social impact? What criteria do you use, and what is the minimum time horizon that you would require to actually establish a confident rating in an institution?
Given the lengthy answers that I've heard, I'm going to take about 45 minutes for this answer. Or on the other hand, I could just say it's part of the secret sauce and I can't tell you. And I think one of the terms that you use is very important when you say, and this is what we always hear from people that are outside of the industry, the term social impact. And going back to the MIT study, this was really one of the big problems with it, is they were trying to measure impact. This is what everybody wants to know. What is actually happening? How are things changing? And is it because of the loan or not, or because of the service or not? That's extremely difficult to measure. It requires, as Asad said, a lot of time, sampling. So what we're looking at is more social performance. We're looking at the MFI and saying, what proxies can we find in order to be able to evaluate whether they're performing well, and whether that will lead to some kind of social results or even eventually social impacts. So I can go through it and we can talk about it later. I can email you much more detail on that. I don't want to get sort of bogged down in the specifics of it, but certainly this is an area that in the past we avoided. When we started doing ratings, we found that MFIs tended to, especially the NGOs, tended to hide behind a social mission. And they hid their operational inefficiencies. And they said, we are serving, this client group that's very remote and so on. And when you really went and kicked the tires, you realized, yes, you're doing that and that's a great service, but somebody else could do it for half the money that you're doing. And at the time, a lot of it was soft money or grant money, and so we wanted to shed light on that, and we didn't want to sort of focus on the social. We wanted to focus on the operational and the financial. Since then, over the last couple of years, we've done, in excess of 60 or 70 social ratings of different institutions worldwide, and so we start to get into how to measure it, and this is an ongoing process that we're learning. And every time we go and every time we have a rating committee, this morning on the train, again, huge discussion. Is this parameter that we've set appropriate? And is this what the investor wants to know? Or is it really what we've sort of concocted? So I don't know if that's a really good answer, but it's at least a partial answer.
Thanks for keeping a potentially very long answer concise.
All right.
Yeah.
I guess this question is for the entire panel, but as we think about capital needs for MFIs, do you think the equity capital markets or the debt capital markets have a natural advantage versus each other? And on the debt side and fixed income products, do you expect that we'll see more unsecured bond offerings or securitizations going forward?
On the debt side, I can speak better, perhaps, than I can on the equity side. I think you will continue to see institutions, that have tested histories, NGOs as well. We did a securitization with Brock. It was a AAA-rated local currency, local market, local, very distinct. And that was an NGO, a Grupo ACP was an NGO doing a bond issue, and then again, the other scale of them. I think the debt side particularly will continue to be robust, and especially in their local markets. That's very important, that some of these institutions are being understood better, how they fit into the domestic landscape, and both from a regulatory and as an institution that focuses on a particular segment. But the needs of both, obviously. On the debt side, to the extent that today you have got a very robust international kind of committed investors and some emerging domestic ones that come much later to the gamble. I think that the debt side will stay robust. There'll be markets that are disrupted like India, but on the whole, I don't think that that's going to hold back the sector. But on equity, I don't know if either of you feel more poised.
Just a comment on securitization, because I think this is, I don't remember what year it was, but we rated the first CDO in microfinance. This must have been 6 or 7 years ago by now, 6 years ago. And at the time, this was the hot thing, and then once we did it, S&P said, oh, we can do this also, and they started to do it, and then everybody started to come out with these products. And we had the financial crisis and a big mess, and then it became kind of almost like a bad word. You say securitization or certainly CDO, and it's like, whoa. But you're kind of seeing groups structure products that are very similar, and they're using different names so that they don't get a bad look. But I think depending on the market, there are different needs, and we have to be as sophisticated as necessary to be able to get the capital in an efficient way to the microfinance institutions and to the end borrower in an efficient way. And just to give you an example, last week I was seated with the central, I'm not going to say what country, but the superintendent and the head of the central bank of a country in Central America. And this was the question they were asking. How should we structure our financial sector? It's not just microfinance. This fits into a much bigger, how should we restructure this in order to allow for that kind of sophistication, but having in mind that we have our local culture and our local issues. And this is a very, very sophisticated question, and a really, really difficult one to answer because it depends on the country itself. And even within countries, different markets have different needs, and different MFIs have different needs. So I would want to see everything from, I mean, debt is let's say the easiest, and so it's usually the first to come. And then you see more sophisticated products that follow. Equity is a much more complicated thing because there's a much more long-term horizon, and also we don't have an extremely liquid market that I know of for equity investments, and so that has to be worked on, both on a regional and on a global level. So I don't know if Asad, who looks at all these things firsthand, and actually has to make investment decisions, I just criticize them, can to say more to that.
I think the maturation of the markets happen when there is a secondary market. And Chuck Olson, who you would hear from later on in the day from our team, has been a vocal sort of advocate for creation of a secondary market, or start to think about that. And so to your question on these capital markets working, you would need to have standardized legal documents. We are working on that. And also you would need to have a mechanism of valuation for a very illiquid instrument. So Chuck worked quite a bit on that last year. But I think those are the two things that we would have.
Thank you. I think we have time for one more question.
Thanks. Thanks for a great panel. Sebastian, we've done a lot of work at the Social Performance Task Force, and I know the social raters have done a lot of work to essentially try to create a market for social ratings of MFIs, and doing a lot of work to convince MFIs, that they should have an external rating of their social performance. Do you see the road being as hard for creating a market for a social rating of an investor? I'd be interested maybe in your answer, but also for Mr. Annibale and for Asad, from conversations you're having
Mahmood, by the same token.
I'll call you Asad. I haven't had the pleasure of meeting Mr. Annibale yet. But just from your conversations with your colleagues, do you see a demand for a product like this, or is it going to be something we're having to, again, convince the market that there's a need for this product?
Can I take that one first?
I'll give you a shot after I answer a little bit. You'll probably want to comment on my comments. Going back to the social rating of MFIs, which is really the official or the first attempt that we've made at doing this, honestly, you know how I feel about it. I think this has been a very artificial process. It's definitely not been demand-driven. The MFIs, I wish, were the ones that were asking for it, and were the ones that saying, this is what we would like to show, and then we could adapt our products to their needs. Unfortunately, there's a lot of other influence in this, and some of it's been good because it pushes to the surface things that maybe people don't want to see, which is great. But eventually, and this is just like an MFI, we have a tough time giving an MFI a good rating that's not sustainable. I don't care how good it is because it runs on donations or some other thing. And so in this sense, we would want to see a demand-driven product that is market-driven, that has actual demand, and the demand has to come from them. Really, right now it's the MFIs, and we have, all these things. As raters, we're incredibly conflicted because we get paid by the people we rate. We could talk about that for a long time. But the idea would be for the people that use the ratings and actually hopefully make decisions, and we help them make decisions, which is another question, to use this. And if it's the social and it's so important to them, then you would think, yes, that would be a product. But that's not a question for me. That's a question for them. And this is where I let Asad kind of go for it. But my question to them, throwing out something, is how much, and this is something you could probably answer offline because you won't want to answer it online, how much does the social criteria and do the social factors actually influence in your investment decisions? How many investments have you made that actually get terms that are different because there's a social component? This would be what I would want to know, because if that's the case, if there is a differentiation, then the social evaluation of MFI is very relevant to you. If there's not, then it's a little bit sort of window dressing.
Why don't you start?
Okay.
You've been waiting.
I think what Sebastian says, I agree with. But a couple of other things that I'd like to add to that debate is first, you have to focus on the core, and then you have to focus on the bells and whistles. And I think sometimes we get lost in this industry, where we talk about a lot of advanced financing instruments and things like that, when the needs are really basic at this stage of the game. You might want to consider how will a business be run if in a small business, not a Citibank or a Deutsche Bank, but a small business where everybody wants to come in and do a different audit for this, audit for that. When will they get the chance to do the business? So the efficiency in doing reviews is important. There is certainly, I think Sebastian told me about this. So trying to do a financial rating combined with a social rating, and there's some thought around that, which has business implications. Yesterday at the Women's World Banking Conference, Samit Ghosh, who runs one of a very nice Indian institution called Ujjivan, said that they collected information on their clients' income. Most of the clients are illiterate, they can't even read numbers. So while it was valuable for the institution as a business, it was also of value to the clients because they really didn't know what their cash flows were. So I think when you are doing these sort of, I guess I have a long history, so I know a little bit of the background. When we started the social performance, they were talking about 200 indicators. And that's 200 indicators. You're never going to, I'm a fund manager. I can't, I'm not Columbia University. I don't have a research department and, to do sort of randomized control trials of long period of time. So I have to look at proxies, and I have to look at the culture, and I have to look at the intentions. Those are difficult to judge, but ultimately we do make judgments. And I think, Leah was right that I think the investors have to be also judged, and the providers have also to be judged, but keeping it balanced within the context of the reality and its limitations.
Yeah, I just say that I think we've watched the evolution of what we're being called social ratings or social valuations or impact, and Asad and I together on the Mix board and other groups like CGAP, and many have been investing a long time in this and tried to be. Our encouragement was not to try to come up with a formula that's going to give you a simple rating, but one that will give us a better sense to make our judgments around. In many ways, we need the data around some key trends and indicators more than we're looking for an answer in that. And we have subscribed to, just was saying to Sebastian, subscribed to it. Was happy to, now that it's more developed, subscribe to some of their ratings. We do with Planet Rating, and we have others that we've worked with. And I think that's important that they also, just in order to advance this sector, that we do subscribe and support where rating agencies are going into this space, because they also need the tension there in dealing with both sides. They need to have a revenue or even an obligation, even if it doesn't it doesn't balance the revenue they'll get from the institutions they're rating, to be able to say, but I have clients that are also paying for me to be independent, reminds one all the time as best they can. It's an evolution. I mean, I think what it's helping us to do, in our case, because everything we do is almost everything is local. Everything is local currency. It's under local law. It's under local markets, local language. We don't mind, whatever, Bengali, Arabic, whatever. That's fine. So we really have to think in that local context, but we don't have the same tools everywhere. And I think that where these are going to help us is when you're doing an assessment of which institutions should you work with or not, you have all sorts of financial tools. We know how to do those. And that's what we said before. We've spent so many years doing institutional building and transparency of institutions. So the mix is a very powerful one. But microfinance transparency is a very young one and just starting, and that's unfortunate that it didn't grow in parallel, to be honest. So we'll use all those tools. We support microfinance transparency. We'll look for the social ratings because I think we are trying to say how really sustainable is that institution, not just from a financial short-term, analysis financially, but as a franchise, as an entity, in a political reality, in a public reality, and with clients. So we're very keen that these do develop, and they will evolve more than just develop. And we have to be an active participant with our risk people in that in order to figure out how do we use them.
Thank you. Just quickly before we wrap up, just to answer, Sebastian, your question on how are these ratings used. I think at least where Grameen Foundation is and where we see a lot of social investors is not so much a differentiation on, this MFI received this rating, and so we will adjust our price on this particular MFI by X amount. I think a lot of the players in the space, if you really looked on a risk-adjusted basis, they may be setting their kind of global targets slightly below at a slightly social return metric. But I don't think, as the social performance indicators are evolving right now, they really are evolving where you would say probably the financial indicators have evolved. They're there. We know what they are, and we're continuing to grow. But there's still more work that needs to be done about defining, bring it from 200 to what? 15, 5, if we can. Whatever the right number is. But I think that's where I see that, to the extent that people are using the ratings, we use the ratings. It does form a part of our social score, whether or not they have one, and we've included actually covenants that they must get a rating if they don't have one within the next 2 years. So we take them seriously, but I think the market is kind of seeing social performance metrics where they are taking them seriously, but probably not yet at a place where it's sort of adjusting pricing on a particular transaction. Well, I think we need to leave it there. I think we've actually gone a little over. One last thing, Asad, very quickly. Yes.
You should go to the Microfinance Club of New York. Google that. There's some interesting videos about the latest debates. I would encourage you to just Google Microfinance Club of New York.
Thank you so much for your questions and your attendance, and a hand of applause for the panelists.